Hello and welcome to today's Office Hours presentation. This is Paul Hoyt, your host. Our Office Hours presentations are a relaxed, informal mentoring program that we do every Monday at noon Pacific time. All these recordings, slides, and exercises are archived in the members area of our website, and all the recordings are available on my YouTube channel at youtube.com/user/Paul Hoyt, at least for now. All 101 after today, 101 YouTube recordings of our Office Hours presentations are available on the YouTube site. I get a lot of coaching from people who say that I should not have them up there on YouTube, but I put them up there because we want to attract attention to who we are. The reasons are that being a successful small business owner can be a very great experience. We know that being a small business owner can be tough. You do need the education, training, tools, and teams to be successful. We want you to get to know us because when you get to know us, you'll know that first and most importantly, we really do care about you. We want you to succeed in every area of your life, whatever that means to you. We want you to find the greatness, the happiness, the divinity that we each have within ourselves, and then embrace it and live it every single day as we try to do. Our passion is to increase the survival rate, accelerate the growth rate, and reduce the struggle rate of businesses in America. And our vision is to help millions of CEOs and entrepreneurs accelerate their business growth and enjoy greater harmony and balance in their lives. And you can pass the word. If you find these Office Hours presentations helpful to you, valuable to you, meaningful to you in any way, we encourage you to pass the word along about them to anybody in your entrepreneurial network. Any other small business owner, and by small I mean somebody with revenues less than probably about 30 million or so. That's the marketplace that we deal with. We know that they can find a lot of value in one or more of the 101 Office Hours presentations that we have that are available on the internet. Our agenda for these Office Hours presentations is an in-depth discussion of a business success principle. Then we offer closing remarks, special offers, and an invitation for next week's session. Then we go into open Q&A and coaching. So as we're doing the presentation today, be thinking about the subjects that you'd like to talk about, the questions that you have about, in today's presentations, raising capital. And at the end of the call, you'll have an opportunity to either type them into the chat log and we'll answer them live, or we'll take you off of mute and allow you to talk to us and the rest of the people on the call too about the questions that you have, and then any other discussion topics. We also invite you to join us in social media with the Awakened CEO communities on both LinkedIn and Facebook, where 4 times a week we publish the business success principle of the day, and every single day we publish the energy of the day posting on Facebook. I think today was number 753. That's 753 days in a row. I get up every single morning and try to say something insightful or meaningful or encouraging or motivational or inspirational to someone out there with my energy of the day postings. It's a great part of my daily practice, and I hope that you enjoy them too. Today's topic is on the 6 stages of raising capital. As always, we try to relate the subject matter of the day to one of the more key performance areas of success that I introduced in my book, The Foundation Factor, in 2004. And this one is all about leadership. It's your responsibility as the leader of your business, as the business owner, as the CEO of your business, to understand what your funding requirements are and what your funding options are. And as always, one of your funding options is the ability to raise equity capital in your business. It's also overlaps strongly with the area of financial management. So if you are the CFO of your company, it's also your responsibility to understand the funding options, understand where you're going to get the cash to grow your business, to start your business and grow your business over time. And interestingly, raising capital is really all about sales. It's not about selling your primary product or service, but it's about selling to other people the opportunity that they have to take an ownership position in your business. And that requires a tremendous amount of sales savvy. It requires specialized languaging, specialized sales scripting, specialized sales processes. We'll talk about that just briefly towards the end of the call today. But so it really interacts these 3 primary areas of business: leadership, sales, and financial management. We also relate the subject matter of the day to one or more of the levels of performance that we defined in the Awakened CEO system. which is a balanced and comprehensive approach to business growth on these multiple levels. And this one is all about all three of them. It's about your mindset, understanding what your attitude can be towards raising capital, the methods that you employ when it comes to raising capital, and all about getting you started and increasing your momentum over time when it comes to raising capital. In our agenda today, we are going to talk about the 6 stages. Stage number 1 is the founder stage. Stage 2 is the family and friends stage. Stage 3 is what I call the friendly angel stage. Stage 4 is the other angels stage. Stage 5 is angel groups, and stage 6 is funds and institutional investors. After we talk about the 6 stages of raising capital, I'm going to talk a little bit about rounds of funding. Then we're going to sum it all up with the bottom line. As we get started, first, this is a very important disclaimer. I'm not an attorney. This is not legal advice. We strongly recommend that you always work with a securities attorney when you raise capital. When we are coaching people and providing business advisory services to a company that is raising capital, we always recommend that they work with a securities attorney. And in many cases, we'll withdraw from that relationship when we find out that they're not getting adequate support, because we don't want to be part of somebody who's breaking the law or putting themselves at risk and putting their investors at risk by not following the rules and regulations of the Securities and Exchange Commission. You will find as you learn more and more about raising capital that many other people break down the stages of raising capital in a different manner than I do. I do it for very specific purposes that you're going to find out in a little bit. And your experience when it comes to deciding what the stages of raising capital are and the actual process of raising capital will be different than what I'm relating today, slightly different, I believe, and different from other people who are raising capital too. So be flexible when it comes to your approach to raising capital. Our focus today is going to be on the traditional methods of raising capital, which is the 504 and the 506B. But we will talk a little bit about crowdfunding because the laws have changed a lot, and you do have crowdfunding options when it comes to these 6 stages of raising capital, and we want to be sure to point those out to you. With that, let's move into stage 1, which is the founders stage, sometimes called the founders round of raising capital. The founders of a business venture can put in time, which is also called sweat equity, but they can also bring capital and credit to the business venture. I've seen multiple times where, the founders will put in, $10,000 or $20,000 or $50,000 or $100,000 into a business venture, but they will also lend their credit, the credit to purchase real estate, the credit to purchase equipment that might go in a plant or a factory, and the credit to guarantee a line of credit from a bank or some sort of installment loan from a bank. So you can bring those 3 things in as the founder of the business, in addition to the talent and the experience and the knowledge that you bring into a venture. You can bring in your time, you can bring in your capital, and you can bring in your credit. Here's one thing that's very, very interesting and is very important for you to know. If you come into a business venture when the venture is just starting and you truly are a founder of that venture, your investments of time, capital, and credit are not regulated by the Securities and Exchange Commission. So here's the deal. With the Securities and Exchange Commission, only affects businesses where somebody makes an investment in a business where it is an existing enterprise and they have an expectation of profit within an ongoing business enterprise through the efforts of others. So it's an expectation of profits, an investment in an existing enterprise, and is through the efforts of others. If the business does not exist, if you're coming in as a true founder of the business and you're in the original articles of incorporation or original member of an LLC, then by definition the business venture did not exist before, and your investment in that business is not covered by the Securities and Exchange Commission. If you're coming into a business and you're taking an operational role in the business, so for example, you want to buy into a partnership where you're also going to be a partner in the business. If you came to me and say, Paul, you want to buy a percentage ownership in your business, I want to work with you in the business, here's my $50,000, we agree upon what sort of percentage ownership in the business that would represent, and you were to work in the business on a day-to-day basis, that is also not covered by the Securities and Exchange Commission, because you're not expecting a profit through the efforts of others. You're expecting the business to make money through your own efforts. So there are conditions under which the investment that you make in a business, or the investment that somebody else makes in your business, is not covered by the Securities and Exchange Commission, and it's important that you know that. The agreements between the founders are absolutely critical. You know, the number one business success principle that I specify in the area of operations is forming great legal agreements. And it's really, really important with your founders that you understand that. I've had multiple occasions where I've talked to people. I've had the experience myself, and I've coached other people doing it, where two people want to start and grow a business, and one person has the business, but they're promising an equity position to another person who is investing considerable amount of time and perhaps even money in helping the business go forward. But you have to really make sure that you keep some good boundaries around that. What you don't want to have happen is that you've invested 2 years of your life and $50,000 of your own money on a verbal commitment that somebody is going to give you or grant you an equity share in the company, but they choose never to do that. I had a business partner, well, I thought they were going to be a business partner in the mid-'80s who I had that exact problem with. They brought me on as a general manager of their business, were paying me a reasonable amount for it, but the promise was that I was going to get an equity interest in the company. And they were just never, ever signed the paperwork. If somebody never signs the paperwork, then you're never going to get that equity interest. So make sure if you're going in to being a founder of a company that you have the right paperwork in place. And I would say be in integrity. If you are a founder of a company and somebody is joining you as a founder of that company, be in integrity and make sure that you back up your verbal promises with something in writing that they can hold on to. After the founders are into the company, and typically after you've made some fair amount of progress on the business, you can move into stage 2 in raising capital for your business, and that is the friends and family round. Friends and family primarily are donating to the founder's dream. They typically don't require a lot of progress or sophistication in the business venture at all. And as a consequence, this is the highest risk of any of the investment rounds because if you're a founder of the business, you have somewhat less risk than a friend or a family because you're actually having something to do with the business and you have some ability to impact the operations of the business and the progress of the business. So I think that actually stage 2 has greater risk than even stage 1 does, regardless of where the business is. This is the highest risk, so sometimes we call this the friends, family, and fools round because, it's only friends and family and those that don't have a lot of sophistication and progress that, typically consider investment at this stage of raising capital. I would say that for some ventures that no other stages are even required. We hear if your company has extremely low capitalization requirements, we only need $30,000. It could be that I put in 10 and you put in 10 and somebody else puts in 10 and we've got all the money that we needed to start the business and we don't need to go any further than the founders round or the friends and family round because we could get an extra $25,000 or $30,000 loan from great Aunt Elva or somebody, and we may not have to go any further. Here in Silicon Valley, there are stories about how 3 or 4 former CEOs of different business ventures met at Buck's Restaurant up in Woodside, California, had a breakfast and decided that each one of them were going to put in $500,000 into the venture and they were going to get another $500,000 or $1 million or $2 million from their friends that they had. And all of a sudden, they've got $2 or $3 million which is all they really needed to fund that next venture. So with some ventures, you may not have to go beyond the friends and family round. Founders will contribute some, friends and family will contribute some, and that's all you need. That's typically not true of large businesses, but it can be very true of small businesses who are just bootstrapping their own venture. After the friends and family round is done, After you've tapped into all of your friends and all of your family members, then we want to go to the friendly angel stage. And this is where my language and terminology is a bit different than anybody else's. I call these the friendly angels primarily because I want to differentiate in between these angels and the angels of stage 4. The difference being that the friendly angels are people you already have a business relationship with. They're typically the professionals in your life, the doctors, the dentists, the attorneys, the CPAs, local business people with whom you have a business relationship or a working relationship. And they will typically overlook the lack of progress or sophistication in your business because they like you and want to have a continuing business relationship with you. And that relationship is a big component of the decision that they make. They're not quite as friendly as your friends and family are. They're a little bit more distant and more removed. They typically require a little more sophistication and progress than, say, a close personal friend would or a family member would, but they still don't require near the sophistication and progress of somebody who doesn't know you at all. I want you to take a look at this graph, and if you're listening in via telephone, I strongly urge you to download the slides because this is one of the most important diagrams that I think I've ever created when it comes to raising capital. And it shows the relationship between somebody's personal relationship with you and their business acumen and their business focus and perspective when it comes to raising capital. A founder is typically 50-50. Typically, a founder is going to come into the business because they like you, because they want to work with you in some way, but they're also strongly considering this as a business venture. They're not going to come in and work with you just because they like you, because their investments are typically a lot more than $5 or $10 or $15 or $20,000. They may be investing, dozens of thousands or $100,000 in their actual capital, and that much value in the time that they're putting into the business and the value of their reputation into the business. So they're going to judge the merits of the business venture not only on whether or not they like you and want to work with you, but also on whether or not they perceive it to be a real business venture and something that they can make some money at and is worth the risk. Now, the impact or the amount of interest that somebody pays because of the personal relationship goes up a lot with the personal round of the friends and family round. Friends and family round are not making so much of a business investment as they are a personal investment. They're doing it primarily because they like you. And then as this goes down and the percentage of perspective focused on the business deal itself goes up considerably as you go up through the later stages of raising capital. In stage 3, it may be 30% or 50% business or 60% business and 40 or 30% personal, or it may be 80-20 in some regards, but it's typically not all strictly business. That changes a tremendous amount in the next stage of raising capital. In the next stage of raising capital, when you're talking to other angel investors, other individual investors, where you've got a new relationship with somebody who hasn't heard of you before or doesn't know you at all, then the picture changes enormously. It becomes much, much more difficult to raise capital when you get out of people who know who you are and who like you and are looking at the business venture primarily based on the merits of the business itself. Just a word about when you can raise capital from those. There's a general guideline that says that you can't raise capital from somebody you just met until you get to know them for 30 days. I know a lot of people that don't pay any attention to that they can meet somebody and they feel comfortable extending an offer to them right away. And I think that's okay if they're a very sophisticated investor. For example, you may go to an angel group and extend an offer to everybody in the angel group right away. But angel groups are almost by definition only accredited and sophisticated investors, so you're not likely to have any issues with that. The reason why we say the 30-day waiting period is because the Securities and Exchange Commission a few years ago issued a no action letter against a company, or for a company rather, that had a 30-day waiting period on their website. So if they found you and met you at a networking event of some kind, or if you found their website and found out that they were raising capital and signed up on their website to get more information, they had a 30-day waiting period if they didn't know who you were, and would not release the offering documents or talk to you about the opportunity that you had to invest until they had, until the relationship was seasoned a little bit, at least 30 days. The Securities and Exchange Commission took a look at that and said, that's okay. We'll consider 30 days to be an existing relationship. I would say that I've seen a lot of people meet somebody for the first time at a conference, and later on that day or the next day or the day after that, after they had built a bit of a relationship with them, they're talking to them about their equity offering, and they're extending to them the opportunity to invest in their business. And I've never seen anybody get into any sort of trouble about that. My encouragement, as always, is to make sure that you're talking with a securities attorney and you follow your securities attorney's advice when it comes to having the conversation about making an offering to somebody who you just met. And oh, by the way, also have the conversation with them about who can make the offer. Almost anybody can introduce you to somebody who may have an interest in investing in your company, but it's only the directors and the officers at the company, and perhaps the vice president of business development, the vice president of investor relations, that can actually have the conversation with somebody about raising capital for their business. These other angels, these people who don't know you or who have only known you for 30 days or so, are likely to be much more sophisticated and require much more progress in your business, especially if they are very sophisticated and experienced. They could be angel investors who are looking to put up, $15,000, $10,000, $20,000, $50,000 of their own money. But this group could include very sophisticated super angels, people who have tens or hundreds of millions of dollars of net worth, and they may be able to take out an entire round of funding. They may be able to purchase your entire, $1 million first round. The way that you find these people is through introductions. Introductions from founders, family members, friends, and other friendly angels. And there are some online services available, bulletin board systems, online angel groups, I call them, that will also help you get introductions to other angels. There are services out there as well of people who have lists of 20,000 or 30,000 different investors that they will promote your business to. Be cautious about those. Generally speaking, unless they are a registered broker-dealer, they cannot take a commission for introducing you to other investors. They can, however, take a marketing fee. As long as you're rewarding them for effort and not rewarding them for results, you can be safe in hiring people to help you market your equity offering to lists of accredited investors. These folks require a lot of progress and sophistication. And here's what we mean by progress and sophistication. First of all, your documents and your presentation quality. You have to have an investor-grade business plan, at least an investor-grade pitch deck, and be very eloquent and polished in your communication style when it comes to talking to sophisticated investors. The reason is because they are seeing hundreds or even thousands of business plans a year. They're hearing hundreds of pitches, maybe even thousands of pitches every single year. And you are, by definition, in competition with every single one of those other people who are trying to attract their attention when it comes to raising capital. So your document and your presentation quality are extremely important because that's the way that you get into the door. Once you get into the door, they really are going to take a look and judge the merits of your business opportunity, your investment opportunity, based upon the team that you have in place, any sort of market traction that you have, and your plan to make money and grow a valuable business. One of the things that they also pay attention to is any other investors who have invested in the business. A lot of sophisticated investors don't want to be the first one in. But if somebody else is in for $100,000 and somebody else is in for $250,000 and somebody else is in for $25,000, you've already raised $750,000 worth of capital from 10 other investors. all of a sudden it starts to get their attention because there's inferred credibility from other sophisticated investors, and especially, by the way, if the people who have invested in your business are celebrities or who are otherwise known to be very sophisticated investors. That can really help your cause when it comes to increasing the progress and sophistication rating that a sophisticated investor has when it comes to your particular business. If you've ever watched Shark Tank, you know how important it is for market traction and for revenues. One of the favorite questions of any of the sharks on the panel is, how much have you sold? How much revenue did you have last year? How much revenue have you had year to date? How much revenue do you anticipate having this next year? Because that's really, really important to them. They want to know that the dog will eat the dog food, which means that the market will respond to your product or service offering in a very favorable manner. The most credible thing that you can say and the most impressive things that you can say goes something like this. We just started 6 months ago. In our first month, we had $5,000 worth of business. And our second month was $20,000. Our third month was $100,000. Our fourth month was $200,000. And I think we're going to double again in the fifth month and have $500,000 in revenue. Believe me, that is extremely impressive, that kind of hockey stick growth, that exponential growth. So that's the type of progress and sophistication that attracts the favorable attention of the other angels. And this is where I want to make just a quick word about crowdfunding. Generally speaking, very, very sophisticated angel investors, angel groups, venture funds, institutional investors are not interested at all in a venture that does equity-based crowdfunding. And the reason is they don't want to invest in a business where there are hundreds or even thousands of unsophisticated investors. Why? Because those unsophisticated investors have rights. Generally speaking, and any investor in your company has the right, for example, to take a look at the books. They have the rights to attend shareholder conferences. They have a lot of rights, and those rights vary a little bit based upon your bylaws of the organization, the state in which you're incorporated, whether or not you're an LLC or a C Corp or an S Corp. But very sophisticated investors know that all of the investors in the business have rights because they understand their rights, and they really don't want to get involved with that, unless it's a very special round, a very special round that infers a lot of special rights to these types of businesses or these type of investors. So be cautious about that. If your intention is to raise $20 million, $50 million, $100 million over the life of your business, not in the first round here, but over the life of your business, be very cautious about making one of the first rounds be a crowdfunding round, an equity-based crowdfunding round. And that includes, by the way, a Regulation A or Regulation A plus. And it includes the regulation, the 506C, which is the accredited investor crowdfunding, and it includes the new Title III crowdfunding, which is yet to be given a name to it. So if you're thinking about raising money through a direct public offering, through a Regulation A, a Regulation A plus, or a state-only public offering, or through an equity-based crowdfunding round, be sure that you know what you're doing, because venture funds, angel groups, institutional investors will not likely to be interested in investing in your company. Here's another little word about that, though. They love to invest in companies that have demonstrated a great market response through a reward-based crowdfunding campaign. So the term crowdfunding really has three different definitions to it, and I did an office hours presentations on crowdfunding a few months ago, so I encourage you to look that up. But there's three different types of crowdfunding campaigns. You can do a donation-based crowdfunding, a reward-based crowdfunding, or an equity-based crowdfunding. They love to see market traction that came through a reward-based crowdfunding campaign, but they don't like to invest in businesses that have raised capital via an equity-based crowdfunding campaign. Why? Because their focus is all on the business. And really, when it comes to stage 5 and stage 6 of raising capital, and this is typically the progression that people go through, by the way. When it comes to stage 5 and stage 6, their decisions are primarily made on the business merits itself. When you get into stage 6, they may not even care whether or not they like you. In stage 5, they will, because, angels, they're typically, making individual investments at that point in time. But so they may care whether or not they like you or not. But stage 6, they don't care at all. So let's talk about stage 5, the angel groups. The angel groups, as we've said, require considerable progress and sophistication. There's often a triage process, so you have to submit an application to have the opportunity to present in front of an angel group, and they typically will have a committee that reviews all of the applications because they can't let everybody in to pitch in front of the angel group who wants to pitch in front of the angel group. It's not at all unusual for an angel group here in Silicon Valley, where I am, to get hundreds of applications to pitch in front of their group every single year. And they hold an event, once a month or once a quarter, where they only allow 5 or 10 people at most to pitch in front of the angel group. So they have to have a triage process to determine which ones of the people who want to pitch are going to be allowed to pitch. They oftentimes have presentations with very strict guidelines, especially very strict time guidelines. For some of them, you may only have 2 minutes to pitch, followed by a 3-minute questions and answer period, or a 15-minute pitch followed by a 15-minute question and answer period. And believe me, if you come to the end of your time and you're only on only on slide 5 of 10, it doesn't make any difference. Your time is up, and your opportunity to pitch in front of that group is done. The members invest individually, but they evaluate the opportunity collectively. So what that means is that once somebody pitches in front of the angel group, they will invite that person to leave the room, and then the members of the angel group will talk about the merits of that individual investment opportunity and do an evaluation collectively. They might do their due diligence collectively. They might do all kinds of stuff collectively, but they do make individual decisions, and each one invests individually. I've seen them form due diligence teams. So I had the opportunity to attend a few angel group meetings, and at the end of when somebody pitched, that person left the room and they said, okay, by a show of hands, who's interested in this particular venture? And they'd have 5 or 6 people make comments on it, and they would talk about it a little bit, and at the end of it, they would say, okay, who's interested in moving forward with the due diligence? And maybe 3 or 4 or 5 people in the room would say that they were interested in moving forward and considering this as an opportunity, and a couple of them would volunteer to do the due diligence and would go out and do the due diligence for the rest of the members of the angel group. So they make investments individually, but they evaluate investments and they do their due diligence on those investments collectively, which means that it's a lot harder to get investments out of an angel group than it is out of an individual angel investor. What we also find, by the way, is they might want you to restructure the offering. So they've invested in typically dozens or even hundreds of ventures over time. They understand what a really good deal is and what a deal is that is attractive to them. So we find angel groups periodically suggesting that you restructure the offering, maybe stop the current offering and form a brand new offering for this particular angel group, which you should consider doing. A few more words about angel groups. Some of them require a fee in order for you to pitch in front of the angel group, and sometimes that's many thousands of dollars for you to go to a trade show or a conference and have the opportunity to pitch in front of dozens or hundreds of angel investors, is a privilege, and it's a privilege that you sometimes have to pay for. Sometimes they have a preferred pitch deck that says that the presentation, in addition to only being 3 minutes long, has to contain these 5 slides, no more, no less. Some, as I mentioned, have weekend or workshop formats with speakers, booths, and public and private presentations. Some angel groups may require a seat on your board of directors. And so my recommendation to you is, if you're thinking about pitching in front of an angel group, ask for permission to attend one of their angel group meetings first, so that you really understand what it's all about and you can be best prepared. Because the competition for investments from angel groups is very significant, very substantial, and you really have to be on your best and have your A game whenever you're pitching in front of an angel group if you have any hope at all in getting an investment from that group. After the angel groups comes the last and the most sophisticated of all, and those are the venture funds and the institutional investors. These are the most sophisticated of all, although we have found some angel groups that are equally sophisticated. Here in Silicon Valley, there's a lady that I took a course in at Stanford University from named Carol Sands, who owns her own, not owns, but she's the executive director of a venture fund called the Halo Fund, and she also has an angel group. And she's the executive director of both of those. So she applies the same level of due diligence and sophistication to investments in her angel group as she does in investments in her venture fund. These decisions, when it comes to decisions made by institutional investors and venture funds, are made by professionals who have a tremendous amount on the line. Their own personal money is oftentimes invested in their ventures. Their reputations are on the line. Their careers are on the line. If they're raising a $750 million fund, for example, to invest in new application software, they're not going to be able to have another fund after this fund closes out unless they've made some very good investments and given their investors a very good return on their money. So their career is on the line. Their reputation, their money is on the line. It's not a game to them. It's not a hobby, and they're not playing around. And in many cases, they don't care whether they like you or not. They're strictly going to make the investment based upon the merits of the investment itself. You can expect a lot of due diligence from them, and oftentimes 90 days or 120 days worth of due diligence, where they will do a tremendous amount of financial analysis, where they will want to interview everybody at the company. They'll want to talk to the investors at the company. They're going to go do their own market research because that's what they do. If they're going to write a check for $5 million or $10 million and it's not a game to them, they're going to make sure that they're doing everything they can to give their investors the greatest opportunity, a very substantial return on investment, and their own money as well. They typically have funds, by the way, focused on specific industries and markets. So not every venture fund or not every institutional investor invests in every deal that comes through or even considers every deal. The most narrowly niched venture fund that I knew of would only invest in Israeli-based software projects. That's it. We only wanted to work with companies that were founded and based in Israel and were a software project, and I think in some cases with a tremendous amount of money already. I've had lots of angel groups that say, we don't even want to consider taking a look at your opportunity unless you already have $500,000 in revenue. That, for example, in 2015, that you had $500,000 in revenue, then we'll consider taking a look at your opportunity. Why? Because they only wanted to invest in expanding businesses. They didn't want to invest in startup businesses at all. They were only an expansion capital fund, not a startup capital fund. And like the angel groups, they may also take a seat on the board. And more importantly, they might also want to take an operational role in the business. It's not at all unusual for venture capitalists to say, we'll give you the $5 million, but here are the restrictions. We have our own terms. We're going to form the agreement. We don't care what kind of offering that you had. We're going to have our own offering, our own ideas about what percentage ownership in the business our investment represents. We want a seat on the board of directors, and you have to hire John as a CFO of the company. They'll put their own people in operational roles at your company, people that they know and they trust, that they've worked with other deals and other businesses, so that they can feel like for themselves that they have their greatest opportunity to get a considerable return on investment. So those are the 6 stages of raising capital: the founders round, the family and friends round, not round, but the founders stage, the family and friends stage, the friendly angel stage, the other angel stage, the angel group stage, and the funds and institutional investors. Now I'll touch the comment about the rounds of funding. Some companies will only have a single round of funding, but others will have many rounds of funding. Those rounds can overlap the stages of raising capital. So for example, if you have $1 million first round, you may start out with founders, then you go through family and friends, then you go into the friendly angels, and then into the other angels, or even into angel groups for that first round of capital, for that Series A round of raising capital. Those rounds can overlap the stages of raising capital, but some companies, may be able to raise their first round or even first couple of rounds without ever presenting to angel groups. They may be able to get it from their friends and family or the other angels that they know or friendly angels that they know, and may never have to present to angel groups or venture funds, or they may bypass angel groups and go directly to venture funds once they feel like that they have a sophisticated enough offering and have made sufficient progress in order to do that. Some companies, however, have to go to funds in the very first round. There are very large ventures. So for example, you want to build an office building, or you want to build an airport, or you want to build something else that requires $100 million in that very first round of funding. You really have no choice but to construct an offering that's going to go for institutional investors and to venture funds, because you simply can't raise capital fast enough from individuals in order to fund your particular opportunity. Here's the bottom line. The bottom line is, think about raising the capital that you need in these stages. You really do have to increase your sophistication and demonstrate progress as you go along. Think about raising capital as you would a new profession. It's something that you study and you practice for many, many months, even years, when it comes to increasing your capability to raise capital successfully for your business venture. That's been our agenda today. We talked about the 6 stages of raising capital, talked just a little bit about rounds of funding, and summed it all up with the bottom line. Here's your homework. Get a securities attorney. Number one, if you're thinking about raising capital, make sure that you have a securities attorney on your team, because if you do not, if you somehow violate the exemptions that are available from the Securities and Exchange Commission, you may have to give back all your money. They may issue a right of rescission to any and all of your investors. So make darn sure to protect yourself, to protect your founders, to protect the investors in your business, that you're doing things in accordance with the law, that you're 100% in compliance, and that, to me, that always means that you're working with a securities attorney who will watch your back and watch over you when it comes to raising capital. Understand where you are in the stages of raising capital and what you need to do in order to be successful at your current level and at your next levels in that. And talk to a lot of people who are raising capital, especially those who have been successful raising capital. You can learn a lot from people who have tried to raise capital and were not successful at raising capital, because some of the most valuable lessons that we can learn come when we were not successful at what it is that we are attempting to do. But I also strongly encourage you to talk to people who have been successful at raising capital to learn what has worked for them. And not just one of them or two of them, but lots of them, like 3 or 4 or 10 or a dozen people who have been successful raising capital. Also, I encourage you to watch other capital presentations, to study the art and science of sales. I made this point earlier, but whenever you're raising capital, you are selling somebody else on the opportunity that they have to get a significant return on investment through purchasing an equity position at your company. And that can be a very, very difficult sale, because typically it's high risk and high reward, and typically it's intangible. There's no guarantee. You're not asking them to invest in an office building or something that has any collateral value. In many cases, it has no collateral value itself at all, except for maybe the intellectual property of the company and the goodwill of the company, but extremely low collateral value. If it came to liquidate the company, if you had to declare bankruptcy, oftentimes the early investors are paid back pennies on the dollar instead of dollars on the dollar. So get coaching and support. You absolutely are going to need it if you are starting to raise capital. Make sure that you got people on your team who have been there, done that before, and can help you manage and navigate these 6 stages of raising capital. We're going to do open questions and answers here in just a minute, where you'll have the opportunity to make comments and ask questions on the topic of the day. I want you to tell me what your biggest takeaways are, what insights that you gained from the presentation, and tell me what you're going to focus on, if you would. Here at the Hoyt Management Group, we have a variety of support services. In some cases, we teach you how to do it with our education and training programs. In many cases, in most cases, we do it with you. We help you write business plans. We help you create financial models. We help you develop sales scripts, to develop product funnels. We help you manage events, etc. And in some cases, we'll actually do it for you. You can throw things over the wall to us, and we will do it for you and come back with a completed work product at the end of our engagements. Our next office hours is going to be on December the 21st, which is a week from today. We're going to do it live group coaching, and that will be our final office hours for this year. We're going to skip Monday, December 28th, as most people will be on holiday, and come back with an entirely new office hours series after the first of the year on Monday, January the 4th. Let me know what topics that you would like for us to talk about on future office hours presentations by going to paulsurvey.com and filling out that survey. And in between now and the time that we talk again next week, do your homework. With that, let's open it up to questions and answers and anything I can do to help you move forward in your business. Stephanie, do we have any questions from the people attending live or any email questions that came in?
How do I find a co-founder? What does that process look like?
Yeah, I've been asked that question before about how you find a co-founder. And I think that the best piece of advice is with people you've already worked with. We talked about how co-founders make a decision to vest in your business based on both business and personal considerations. Whenever I have considered being a co-founder, and whenever I have considered bringing in co-founders for my business, it really is the people that you've worked with before who I encourage you to consider for co-founders, because that working relationship is so valuable. Partnerships in general have a higher divorce rate than do marriages. Here in the United States, unfortunately, our divorce rate is in excess of 50%. As it turns out, business partnerships have a divorce rate in excess of 75%. So you need to do everything that you possibly can to give yourself the very best chance at a great business partnership. And my favorite piece of advice here is to make sure that you have a long working relationship in place. Far better to have a working relationship with somebody and have the working relationship come first and the friendship come second than it does to have the friendship come first and then you try to form a good working relationship around the friendship. So make it a working relationship, not just a friendship relationship. That by far is the best place to find a co-founder. And if you can't find a co-founder amongst the people you have already worked with, then ask the people you have already worked with to help recommend a co-founder to you. So in this regard, it's a lot like dating. Where do you find a potential mate? Where do you find somebody to date? 20 years ago, before Matchmaker, online services came about, we did that through organizations that we belonged to people that we had a working relationship with, and to friends of our friends. So those are also great places to go look for co-founders for your business. And just, raise your hands and say, I'm looking for somebody to go into this venture with. And by the way, I'm a big fan of having co-founders for your business, because it's real important that you have sales and visionary, and the engineering covered at your business. There's a presentation I did on Nail It, Then Scale It, which is a great book. I may do another office hours presentation on them. Talks about the importance of having somebody who has sales experience, somebody who can actually help build a new product or service, which is the engineer, and somebody who can carry the flame, the visionary or the leader with your business. So I encourage you to think about having co-founders and going into business as a partnership, as much as possible, and go find those people, wherever you can find them. Hopefully that was helpful to you. Next question, Stephanie.
None of my friends or family have any money. Where should I start?
If your friends or family don't have any money, that means that you're skipping stage 2, but that doesn't mean that you have to skip stage 1. So you can find founders who may come into the business, and if they don't have any money, they can come into business at least with equity capital and talent, or not equity, but with sweat equity, and come in with their time and their talents to help you get the business started. If you can't find any founders, or if the founders don't have money and you don't have any money, then almost by definition you have to go to stage 3 right away, which is the friendly angels. And that means that you have to have more sophistication and progress to demonstrate than you would if you had friends and family who might consider an investment in your company. So, you got to jump to either stage 1 or stage 3 if you don't have any capability of stage 2. I would say that you may have some capability of stage 2, even if it's just a few $100s a donation, or a few $1,000s in a personally backed loan that people can give you to start. If they really see, that you're passionate about it, that you're determined about it, that you're putting everything into it, they may be able to come up with a few bucks, a few $100 or a few $1,000s, where they would never even consider that unless you demonstrated your own passionate determination to make this venture succeed. Then they may feel a little more charitable about donating to your cause and making an investment in your company. But that's the bottom line. If you don't have a stage 2, then start with stage 1 and immediately jump to stage 3. However, that means your job's tougher. By definition, when you get to stage 3, it's tougher raising capital in stage 3 than it was with stage 2. So you have to demonstrate more sophistication and more progress. Stephanie, other questions?
Josh says, great presentation. Thanks for the kind words. I'm considering the friendly angel crowdfunding route, and it sounds like donation-based crowdfunding is the way to go. But how do I decide between going in that direction instead of 1 or 2 investors? Is it a dollar amount that drives that decision?
I don't know that it is a dollar amount that drives that vision. And with you, Josh, I know a little bit about your venture. So, I don't know that it's donation-based crowdfunding for you, but rather reward-based crowdfunding. So in reward-based crowdfunding, you're, giving people a discounted membership. For $250, you can get a lifetime membership. Or you're saying for $20, you're getting a T-shirt, or your cost of delivering the T-shirt is only $5. But there is, some sort of reward associated with that. Or for $1,000 that you get a day's worth of time with me, in addition, and that becomes their reward. So with reward-based crowdfunding, a lot of times we are selling or pre-selling the products and services that we have at a discount, or we're offering some other merchandise available for sale, at a discount or even at a premium to get the money that we need. And that may be the best route for you. If you're considering doing an equity-based crowdfunding, which right now the only legal option is the 506C, that still requires working with securities attorneys and still requires a lot of sophistication. I think this is a good question for us to take offline, and a question for your other advisors as well. I know you've got other advisors on your team to really evaluate the pros and cons of doing a reward-based crowdfunding campaign, an equity-based crowdfunding campaign, maybe even a direct public offering or a Regulation A or Regulation A plus offering, or waiting for another 4 or 5 months, 6 months until the new Title III non-accredited investor crowdfunding opportunities become available to you. I'd really love to. I like I like you a lot, and I like your venture a lot. And by the way, one of the things that a lot of people forget when it comes to raising capital is that anybody you have a business relationship with, which means all of your customers, by definition, you have a business relationship with them. You have a pre-existing relationship with them, and you can raise capital from them. You can extend your capital offering to them. You do have to be cautious about whether you're doing a 506 or a 504 as to whether or not they're sophisticated or they have to be sophisticated, but whether or not they're accredited or unaccredited. But for example, with 504 offerings in most states, you can have up to 35 or at least, if not more, unaccredited investors. You can do that with a 506 as well, as long as you have a private placement memorandum in place. If you want to do accredited investors only, you don't have to have a private placement memorandum, but you really have to watch with the number of people that you extend the offering to whenever you're raising capital. So I've got clients right now that I have hundreds and maybe even thousands of customers, and they can extend their private offering to every single one of those customers as long as they're doing a 506B and as long as They keep track of the number of non-accredited investors that they're extending the offering to and actually signing up to be investors. So hopefully that was helpful to you in some way. Next question, Stephanie.
Okay. Where do I find a good securities attorney?
Talk to your business advisors. People talk to other people who have raised capital before, and talk to your business advisors as to who they might recommend that you work with as a securities attorney. And by the way, this is a classic case of what I call the 3 expert rule. I do not recommend that you sign up the first securities attorney that you come to. Talk to 2 or 3 about them, because their services vary a lot and their fees vary a lot. And I wrote about this in the book that I wrote a few years ago that I didn't even mention in today's call, called the Capital Coaching Program. But I write about the difference between different securities attorneys. Some of them have escrow services. Some of them will make sure that they attend the closings with you. Some of them will keep track of all of your compliance documents, and some of them will issue your shareholder and your stockholder certificates. And some of them don't do any of that stuff. Some of them will introduce you to investors. So be sure that when you talk to your securities attorneys, that you ask those questions about exactly what their services are and whether or not they can introduce you to investors, because their services do vary a tremendous amount. So talk to your business advisors about who they've worked with in the past. Talk to your CFO, talk to your other founders at the company, and interview a lot of different securities attorneys so that you can get the ones that meet your needs. Generally speaking, by the way, I always say that it's far easier to raise money in your hometown than it is in a town across the country. So we typically raise capital where we live first. Why? Because that's where we're going to find our friendly angels. By definition, our professional acquaintances, our doctor, our lawyer, our attorneys, our dentists, are in the town in which we live. So we raise capital in our hometown first, and then we broaden our horizons and we begin to raise capital in other areas of the country. So if you're looking for your securities attorney to help introduce you to potential investors, it makes good sense for you to have a securities attorney that's in your hometown. So if you're in San Francisco or in the Bay Area, find a securities attorney that is used to doing business here in the Bay Area. If you're in Salt Lake City, Utah, find a securities attorney who can help you raise capital in Salt Lake City, Utah. And the same is true about New York City, Chicago, Houston, Dallas, Atlanta, etc. I believe that it's a good idea to consider at least having a securities attorney who is in your hometown, because they'll be better able to help you out in those early stages of raising capital. Hopefully that was helpful to you. Stephanie, next, and by the way, I have after the top of the hour, so I'm willing to stay on the line here as long as anybody else wants to stay on the line and answer these questions. That was a fairly long presentation, but of course, if you're raising capital, it's very, very important to you. So let's stay on for a few more minutes and see if we have any more questions. Stephanie.
How can you support me in the capital raising process?
We kind of mentioned that a little bit. I've worked with hundreds of people who are starting to raise capital, from those early conversations where I've handed them a pen and a piece of paper and had them write down their business idea for the very first time, into preparing themselves to be capital ready, through a simple business overview or a simple conversation about how much capital to raise in their first round of business, into helping people, supporting people in much more sophisticated rounds. In the other rounds where there are Series A and Series B, where they need an investor-grade business plan and financial model, or even coaching through that, we do all of that stuff. So I've written a book on raising capital called the Capital Coaching Program. I've written dozens and dozens and dozens of investor-grade business plans and investor-grade financial models. So the bottom line is that we can help you through, I would say, your first 2 or 3 rounds. If you've already raised $10 million in capital, or you've already raised $20 million in capital, and you're in round C or D, you probably don't need help from a fellow like me. You need help from other people who have experience with those later rounds. But our expertise is in those early rounds, people who are raising their first, I would say $1 to $5 million in capital. And we have a wide variety of services that we can bring to bear on your capital raising venture. So, and we'd be happy to talk to you about that. Just reach out and give us a call. We'd be happy to share whatever we can with you. Let's do another question, Stephanie, if we have one.
I'm being told to raise $20 million in my first round. Do I need to start with stage 6?
I think almost by definition you do. Because typically angel groups, which are stage 5, don't invest among the members of that group more than $250,000 or $500,000 on any one venture. If you go to an angel group and you get 20 people in that group to put in $25,000 apiece, or 10 people in that group to put in $50,000 apiece, I mean, that's a home run, but that's only $500,000. If you're looking to invest, get somebody to invest $20 million worth of capital in your business, you almost by definition have to go to the venture funds and the professional investors and the institutional investors, and that requires a tremendous amount of sophistication and progress, because they are seeing literally thousands of investment opportunities every single year. That's one way to answer that question. The other way to answer that question is, do you really need $20 million in your first round? The only condition in which I've ever seen that actually be successful is with somebody raising money to build a very large real estate development project. And they really did need, $100 million to build 1,000 homes, or they needed $50 million to build a 20-story office tower. And that was the only way that project was going to get going, was because they needed to raise all of the capital to fund the project before they even started the project. If you're being told to raise $20 million in your first round and it's a product, or if it's a service, then I would question that advice. Here in Silicon Valley, that's not the way that we raise capital here at all. We do it through rounds of funding, where the first round is $1 or $2 million, the next round is $3 or $4 million, the next round is $5 or $7 million. You really don't start to have $10 million rounds until you're at round like 2 or 3 or 4. So I would really question that. I've never seen anybody be successful raising $20 million in their first round of funding. I have seen people be successful raising $500,000 or $1 million, or maybe even $1.5 million or $2 million in their first round. But to raise $20 million in your first round either takes a highly collateralized venture like building an office building, or incredible amount of luck. You would have to have Donald Trump on your, as a co-founder in your business in order to raise $20 million in your first round, under most circumstances. So I would ask the advice of other people as to how much money you should raise in that first round of funding if somebody's giving you advice to go out and raise $20 million in your first round. Hopefully that was helpful to you. And I do have 107, but I'm going to take another question. And in fact, I'm going to stay on here for another, 5 or 10 minutes if somebody wants to stay on and they have additional questions. Stephanie, do we have any other questions?
Can you talk about sequencing to raise $1 million startup for a nonprofit?
Today none of the conversations that we've had was about nonprofits. So today was all about a for-profit enterprise where somebody is investing in it and taking an ownership position in a for-profit enterprise. Nonprofits don't have investors. They have contributors or people who make donations, and they do not have owners. Now, by definition, a nonprofit is not owned by anybody. A nonprofit is owned by, in essence, the state or the federal government. So there's no conversations that we had today about raising capital for a nonprofit. I did do an office hours presentation on nonprofits. I think it was in June or so 4 or 5 months ago, that you may want to look up. When it comes to the sequence of raising capital, for a for-profit venture, that first $1 million, typically we raise a little bit of capital through maybe a convertible promissory note or donations from others, or the investments of founders, or maybe even personal debt that you're paying back to a close family member or a personal friend, in order for us to create the equity offering itself. We have to define the business, and that typically means paying advisors to help with the branding, to help develop the investor-grade business plan, to help develop, paying a securities attorney to develop the capital offering. And that will typically take $20,000, $25,000, $30,000. You may need to go to a conference and get training in raising capital. So it's pretty easy to invest $30,000 or $40,000 or $50,000 in preparing yourself to raise capital before you go out and begin to raise capital from the friendly angels, from the friends and family, and from other angels. So typically I find that individuals do that in a series. They will have a $100,000 seed round, which may be promissory notes or convertible promissory notes, or very, very small equity offerings. And then they go in to do their Series A, which may be a $500,000 or $1 million in that initial offering. A general guideline is that you don't want to do more than 10% of your initial series, your initial round, in the form of debt or in the form of convertible promissory notes. So if you're raising $1 million, you can think about raising, $100,000 or so, preferably less, in the form of convertible promissory notes to help you develop the equity offering. And by the way, my favorite one is a convertible promissory note where you have no intention of paying back the money, that the money is to be converted into an equity position in the company as soon as that first equity offering has been developed and is available. And then we convert the money which somebody loaned us into equity shares in the company, typically at a premium or a bonus to them because they came in at an earlier stage, but you have no intention of paying that back. Debt for an early stage business, is extremely expensive because eventually you have to pay that debt back, and it takes away from your expansion capital in order to do that, and can really constrain the growth of a business. So I'm not a big fan of debt that is to be paid back. I am a fan of convertible promissory notes where the debt, the loan that has been made, is really intended to be converted into an equity position at the company and never paid back to the person who made the loan until we have a distribution of profits, and then that's the way that they get their money back. Hopefully that was helpful to you. And the questions continue. Let's take one or two more, and then we'll finish for today. And by the way, if your question didn't get answered, our office hours presentation next Monday will be live group coaching, and you're welcome to come back at noon Pacific time next Monday and ask any and all questions that you had with regards to raising capital or anything else about starting and growing a small business. So let's just talk about one more question, and then we'll call it a day. Stephanie, what's the last question?
How do I decide how much money to raise?
There are two primary ways of doing that. One of them is just through, through, I would say, taking a shot in the dark. There are some people who are so experienced at raising capital that you can describe your business to them, and they'll tell you, you need to raise $2 million. You need to raise $1 million. You need to raise $5 million in your first round. If they tell you you need to raise $20 million in their first round, I would really look into that. But if they tell you because of their experience, that can be a good kind of rule of thumb way of deciding how much capital to raise in the first round. I am an analyst, so I analyze everything. I think the right way, or at least a way that I would advise you to consider when it comes to figuring out how much money to raise, is to do a financial model. Develop the strategy for growing your business, put some numbers to it, figure out how much cash flow is really going to be required to grow your business, and raise the capital that's required for you to execute the strategic growth plan that you have in place. And I have seen that initial number be anywhere from $100,000 to several $1 million, depending upon how much money you need for inventory, how much money you need for accounts receivable, how much money you need for product development and engineering, to raise your particular, to start your particular venture. So for example, if you want to start a coaching business, you may only need $20,000. You may not need any equity capital at all, because the only thing that you need is a little money for working capital for yourself, for training, for branding. In a matter of 60 days and a little bit of money, you can be out with the coaching business. If you have a product company where you're bringing a consumer product to market, I really think that $250,000 is the minimum amount that you need in order to bring a product to market that's a consumer product. And I really think that it's more like $500,000 as a minimum. If it's a medical device, that minimum is probably more like $1 or $2 million, because it takes a lot longer to bring a medical device to market than it does a consumer product, because of the regulations and the FDA and all of the other certifications and compliance stuff that you have to go through. If the product that you're bringing to market requires patents and international patents, you may have another $50,000 or $100,000 at least required in that initial round to pay for that patent work, to pay for that intellectual property work. So the right answer there is, I'll take a note from my attorney friends and say it really does depend. Depends on what type of business that you have, depends on the intellectual property requirements of that business, depends on the time and the money it's going to take for you to develop your unique offering to the marketplace, especially if you're bringing a tangible product to market, either as a consumer product or as a business product or as a medical device. It depends on how many people that you need on your team to bring it to market. Here in Silicon Valley, for example, that first round has a tendency to be a $5 or a $10 million round, but that's after friends and family and founders have put in a significant amount of money and time by themselves in order to demonstrate their capability to create a software product or a network appliance product, so that the sophisticated investors, the venture funds, feel more comfortable making that investment in their first round of funding. So it really does vary. It's all up and down. Ask your advisors, ask your capital coach to help you figure out what those rounds of funding need to be and how you're going to use your proceeds in the first round of funding and how you approach that. I think that would be very wise. For those of you who attended our call today, I really appreciate you attending the call. I appreciate you sticking around for the questions and answer period. I invite you to come again next week to where we're doing live group coaching. Towards the tail end of this week, Thursday, I'll be in Las Vegas at the CEO Space Entrepreneurs Forum. It will be my 57th or 58th conference. I missed in October. I'm really looking forward to going back for the weekend, and I know I'll see some of you there. So hopefully I'll get to see some of you face to face. We'll see some of you on our last office hours call for the year next week at noon Pacific time on Monday, December the 21st. And until we meet again, either over the phone, in person, or on our next office hours, this is Paul Hoyt wishing you a most marvelous and prosperous day. Bye-bye.